Oh, I forgot to ask about Hot Pockets. Yeah,
Oh,
you had a Hot Pocket lately?
I can't lie. I'd never had one, and don't tell Elmer Fudd,
All right, I won't tell him.
because but a couple of weeks ago, I think I was in a very bad state about the way the stock was acting, like a typical day with Tesla, where something you think should cause the stock to go down 10% and it rallies up 2%. So I went down to Dwayne Reed around the corner in honor of Elmer, and I did eat some Hot Pockets, and they were delicious. And it's some high technology, the tinfoil thing and everything else.
Yeah, in the microwave. Yeah,
But yeah,
and
I was pretty impressed.
you don't start a runaway fire. It's awesome.
Yeah, exactly.
The Tesla Q podcast is for informational purposes only and is not intended for and should not be used as financial, investment, or trading advice. Research associated with fiscal decisions should be conducted elsewhere. The host of the show possesses no license or credentials to warrant accepting advice based on what is heard on the Tesla Q podcast. Additionally, even though the host and guests may hold positions in companies discussed on the show, they don't have insights into the next time step of the simulation. Therefore, do not make any financial decisions based on the contents of this podcast.
Hello and welcome to episode number 20 of the Tesla Q podcast. We did just release an interview episode yesterday, but got another one here tonight. So look forward to that. Remember, if you want to make a contribution to the podcast, go to the Cash app and search for Tesla Q podcast, or go to cash.me/Tesla Q podcast. And apologies, that does only take debit cards, and apparently not all debit cards. Also, if you want some merchandise, go to the Shorty Store at evacuationboy.com. And with that, we'll get to the interview. Hello, this is episode number 20 of the Tesla Q podcast. I'm joined today by Ed McCabe. Ed, welcome.
Thank you. Thanks for having me.
No problem. I heard you in a little bit of a short clip on a podcast a few days ago, I think. So wanted to hear from you a little bit more. So to start with, how about you just give a little bit of your experience so people know where you're coming from?
Sure. I've worked on Wall Street since 1996. Started on the sell side as an analyst covering technology stocks. In fact, I covered the first dot-com bubble, so I've seen extreme valuations and all kinds of bloodshed thereafter. And after I left the sell side, I've worked at a variety of hedge funds, including one that I had for myself for a period of time. So I've been in and around stocks in the markets. Oh boy, now it's 23 years. So that's kind of the angle I come from. I know there's a lot of people from the Tesla Q audience or group that brings so much valuable expertise from so many disciplines that I don't know. So it's really been a fascinating crowdsourcing kind of experience. So again, I really appreciate you having me on.
Yeah, I think that's one of the most unique aspects of Tesla Q, and is part of why I ended up starting this podcast, actually.
Yeah,
so
I've listened to Keith, and I've listened to Keith now, and Phoenix, and Tesla Charts. So you've had some really great guests.
And Montana Skeptic. Don't forget him.
And Montana
I don't know if you listened to that one or not. Yeah,
I did. Yeah.
So in your career, have you mostly been on the long side or the short side or somewhere in between, mixture of the two?
You know, I've done both. On the sell side, you're kind of writing research, and in the era I did it, it was very long oriented. But then on the hedge fund side, I've done a lot of shorting. It's actually been something I've gravitated toward. Also in my personal life, just as way of background, I helped uncover a small cap fraud where, I sent one guy to prison for 7 to 21 years, or at least I had a hand in it, helped the prosecutors get educated. So, and I gained that experience by having lost money myself, and then, really wanting to go after the guys who had committed the crime. And in doing so, got a real inside look to how these things can work. Now, this was a much smaller cap company that this happened with. It was a $210 million fraud. But you really get the mechanics of how people act when they're in desperate straits. So yes, I've always had an inclination toward the short side, just because I find it more challenging. Sometimes I regret that I gravitate towards it, but it's a natural inclination for me for some weird reason. Might be the law enforcement in my family.
Yeah.
It's in the DNA.
Seems like a lot of people like to paint short sellers as being evil or something to that effect, which I take some issue with that, because really the role that we're playing in a lot of ways is a consumer protection role, a little bit of an investor protection role. Like with the interview that just went out yesterday with Keith, safety role. We had the unfortunate crash from yesterday down in Florida. So
yeah, I think you're absolutely right. And I think when you look at the regulatory environment across many disciplines, whether it's the NHTSA, where kind of Keith brings a perspective, or it's the SEC, and we'll talk about this because things kind of changed with them tonight, but up until this point, they've been asleep at the switch. So I really think of short sellers as the cops in the market. And they take a tremendous amount of risk being short. And the idea, and I know what happens from time to time, but the idea that there's this cabal of networked people working against the stock, if you are a good company, generating cash flow, run well, you should relish short sellers in your stock because all they are is latent buyers. They're eventually going to have to cover if you are running this company well, and that will be nothing but fuel for your stock. So in my history, anytime I've seen a CEO who was obsessed with short sellers, it's always been a company that had something to hide or was in trouble. And maybe that'll be the case here with Tesla.
Yeah, I've heard similar things from some of the interviews that Mark Cahotis has done on the Quote the Raven podcast. So that sounds very familiar to me. Before we go any further, would you like to add any additional disclosure, but beyond the standard one that I have at the beginning of the episode?
Yeah. I'd say two things. One is, this is not investment advice from me. I don't hold any licenses at the moment. And to the extent we talk about anything legal related to the SEC or otherwise, I am definitely not a lawyer. I've been around the law like I told you when I dealt with the previous fraud, and so I kind of know the rules, but I'm not a lawyer, and I wouldn't misrepresent that in any way. And
neither am I. So, and I'm not licensed either. So don't take any of what I say as investment or trading advice. So
okay.
So you mentioned that things just changed with the SEC this evening. So do you want to go ahead and describe what we're trying to figure out here? Yeah,
I think it was around, Eastern time, around 6:15. I saw the stock drop like 3-4%. So I, immediately went on the internet to see what had happened. And what we saw was that the SEC filed a show cause order. Basically, the SEC has gone to the Judge Nathan, who was the judge. Let me back up because I don't know the audience entirely. In August, Elon Musk committed what I would consider the most egregious securities fraud in market history when he said he had a going private bid for the company at $420. And what we found out in retrospect is that he in fact did not. And then the SEC sued him, and he settled with the SEC. And he had, terms of that settlement, and the terms were, pay $20 million personally as a fine. The company would pay $20 million. He couldn't deny the allegations, and that he would have his communications, including his tweets, overseen by a committee within the company. And so he did that settlement. But it seems to me, shortly after doing that settlement, he really just thumbed his nose at the SEC. And if you go back to when the original settlement, when he was originally sued, he turned to his board and said, either you fight this with me or I'm going to quit. I'm going to take my ball and go home. And so he came out with kind of a defiant statement, and he's often defiant in the beginning, and said he was going to fight this, and he was, integrity was the most important thing to him. His stock got killed the next day, and I think that day was a Friday, and by Saturday they had settled. Okay?
Yeah, and I think the original fine was $20 million, and then with the settlement, after they'd initially rejected the initial settlement, it got raised to $40 million total. So
yes, it was $20 million from Musk personally and $20 million from the company, so $40 million total. But what I noticed right after he settled, and I gave you that fight or I'm out of here, mentality he had. But shortly thereafter, he was on Twitter mocking the SEC, referring to them as the Short Seller Enrichment Commission. Then he went on 60 Minutes, which doesn't have a bigger audience in America, and he basically told the world he doesn't respect the SEC. And then he issued many tweets that I thought were flagrant violations of the settlement agreement, with February 19th tweet, which we'll touch on, being the most egregious. And so anyway, basically what happened was on February 19th, he went out and said that Tesla would produce, around 500,000 cars in 2019. Now, only January 30th, the company gave guidance that they produced 360 to 400,000 cars in 2019. So a completely different number. And then 4 hours later, he comes out and kind of retracts that statement and says, we'll be on a run rate of $500,000 by the end of the year. And so what that prompted the SEC to do, what we learned tonight, is that they've gone to the judge and filed this show cause order is to hold him in contempt because he has violated the agreement. And when you look at the show cause order, it's not just the content of the tweet, which is material inaccurate. But really what we learned from that show cause order is he had no pre-approval for that tweet, which was required. And in fact, none of his tweets since they put this settlement agreement in place have been pre-approved. And then the final thing I read in there that I thought was very strong language from the SEC is that they basically said, Musk has not made a diligent or good faith effort to comply. So it really sounds like the SEC is loaded for bear because they've been embarrassed now. They gave him a slap on the wrist, and he turned around and basically mocked them thereafter. And I think even as, I'm a critic of the SEC, and there's a lot of people who critique the SEC, but there comes a point, I don't care who you are, if you're a professional and you've been mocked and embarrassed to a certain extent, you need to, you need to do your job. And I think we're at the point with the SEC, he's forced them into a corner. They have to do their job.
Mm-hmm. Yeah, and I actually came across that clip from 60 Minutes just earlier tonight, and I retweeted it. It was on December 7th, I believe, and Elon clearly stated in that interview that he wasn't going to have people monitoring his tweets, and and then he said, "Let me be clear, I do not respect the SEC. I do not respect them." So that was a very, very flagrant violation of the settlement from my view.
Yeah, from my view as well. And the other thing, and this is just speculation on my part, but there's no doubt in my mind that Tesla needs to raise capital. And there was no doubt in my mind December 9th, and probably not in his, that he needed to raise capital. And when he said that, and that was unprompted, I mean, if you look at that dialogue between Leslie Stahl of 60 Minutes and Elon, she didn't prompt him in any way to lash out at the SEC. And it makes me wonder if he knew in terms of what was going on in the investigation with the SEC and the DOJ that he maybe couldn't raise capital. And this was him, lashing out at that fact. I don't know that. It's just speculation, but it just struck me as odd that he would lash out against the one agency that stands between him and the capital markets when he needs capital.
Yeah, and some additional speculation that I've seen just tonight on Twitter is that possibly this is an attempt by Elon Musk to somehow be forced out of Tesla and have somebody else to blame if it does, in fact, go bankrupt, so that he could say, it wasn't my fault, it was the SEC's fault because they punished me for this just for saying some words. And I don't know. That's just speculation, though, that's going on right now.
It's a pattern with Elon, to my observation, that there's always somebody to blame. There's a saboteur. There's big oil. There are short sellers. There are traditional auto manufacturers. And if he knows this is going down, he's going to get forced out, or he wants to get forced out. I've said to people oftentimes, this is like suicide by cop. I mean, he's been taunting the cop on the beat in our business, which is the SEC. I don't know what his motivation is. He's very hard to figure out. He doesn't, his psychology I couldn't put my finger on. But, man, I've never seen somebody taunt the authority that governs him the way he does. So I don't know. And I'd also say this, because I'm seeing a little speculation on Twitter already, where some of the bulls are saying, well, maybe he remains CEO, he pays a larger fine, he has to step down as director. And I'd say two things. One is the way the SEC has been embarrassed and the way that show cause order is written, I think they're going to take a hard line with him. But even secondary to that, if you are a director right now, and obviously this has been a travesty in terms of corporate governance, this company, but if you were a director right now, and we've just revealed that you never even implemented the oversight of his tweets the way you were supposed to, or all his communication, you really have to ask yourself, is he fit to be CEO anymore? Or is he introducing me personally to liability that I can't really take on as a risk? Am I in self-preservation mode? Do I have to lawyer up and protect my interests as a director? Because what he's done now is so flagrant, it's questionable whether he wants to be CEO and whether he's fit to be CEO.
Mm-hmm. So relating back to why Elon might not want to be CEO anymore, the way his compensation structure is set up, it's fully equity-based, so it's options. He doesn't, I think his salary agreement, which I just read within the last couple of weeks a little bit of, he gets California minimum wage because that's that's the law in California, but he decided not to take it or deferred it or whatever. But so his only compensation is Tesla equity, basically, other than his holdings in SpaceX and the Boring Company. So his liquidity position, his personal liquidity position, is not rosy right now, and that's clearly evidenced by this recent revelation that he mortgaged 5 different properties on December 18th for about $61 million, which we were talking about it on Tesla Q Twitter at least 5 days, maybe a week before there were news articles about it. But late last week, I believe it was, news articles started coming out about it. So that's just one small example of the news cycle and how we're a little bit ahead of the game on Tesla Q Twitter than if you're only paying attention to mainstream media. So
yeah, I don't even, if you go back to 2017 was the last disclosure of his margin loans. I think he had somewhere in the neighborhood of $700 million of money borrowed against Tesla stock. And since that time, we've seen rounds of financing, an equity round for SpaceX in April, a senior secured debt round in November for SpaceX, an equity round in December for SpaceX. I'm sure he participated in all of those. I'm not sure, but I think he probably has. The Boring Company, I think, raised to $100 million and change. I'm sure he participated. I think that's documented that he put over $100 million in that. So he could be approaching, $1 billion of margin loans, and now he's gone and mortgaged the houses. He is arguably in a pretty precarious liquidity situation. We know he's got paper wealth as long as these stocks and these equity values hold up, but he's probably got a monthly budget that rivals Floyd Mayweather Jr. is what I always say. But anyway.
Yeah, and speaking to his 2018 capital outlay, there's a Twitter user, the handle's EV Defender, who has laid out clearly a minimum of like $286 million in 2018 that Elon paid. I think it was about $100 million in a SpaceX raise that was actually disclosed, another $100 million for a Boring Company raise that was disclosed. And then there's the possibility that he was involved in that December 18th through 21st or whatever SpaceX raise that got 273 of $500 million. So a minimum of $286 million. Yeah. And it included his, it included that, the $20 million, well, the $19,999,000 that he was basically just paying back Tesla for the $20 million SEC fine, and then also the open market transaction from earlier in the year, I think. So
yeah, that's probably relatively close to what I was talking about. Something approaching $1 billion. I mean, $800 million, $1 billion, it doesn't matter. It's a ton of money. And when you're a leveraged person, because you borrowed against the stock, and the stock you borrowed against is the equity of a leveraged company, it's the potential for a tough situation.
So I think on Twitter I've seen you mention that this is maybe the biggest fraud that you've ever seen in your career. Is that? Well, am I remembering right, or do you want to word that differently?
Yeah, no, I don't. I don't think I've used the word fraud. I mean, there's a lot that's curious. Let's put it that way. I mean, in terms of funding secured, he was sued for fraud. He did settle that fraud case. That I think is cut and dry fraud. There are a lot of things that are curious as it regards taxes, accounting, dealing with refunds of deposits, dealing with the discrepancy between registrations and deliveries. I would call those things curious at this moment. I can't say definitively that they're fraudulent, but they are curious is the best I can say.
Yes, very, very curious in some cases.
But, just a lot of things that are curious. And they all come back to me to the critical thing here, because going back to my early days in this business when I was covering the .com craze, which eventually crashed, I watched a lot of very seasoned investors, much older than I was at the time, get taken out on stretchers trying to short things based on valuation. You have to have a catalyst. And to me, it's always been about, can this company consistently generate cash flow? And we know about the immaculate quarter of, the third quarter, which there were a lot of curious things going on there as it regards just rebates potentially. And in the third and fourth quarter were obviously back-to-back profitable quarters, and I think there was just a lot of gimmicks at best in those quarters, whether they were rebates, whether they were, CapEx that annualized at $1.3 billion in the fourth quarter, well below what maintenance CapEx is, whether it was flat R&D for a tech growth company, whether it was SG&A being down year over year, and SG&A down and CapEx weak when you don't have a infrastructure for services that is up to snuff, where you don't have supercharger network up to snuff, where you're trying to introduce new models, where you're trying to build a plant in China in record time for a record low amount of money. There's just a lot of things that don't add up. And all of it's happening as we approach a very key date, which is March 1st with this convert due. And obviously this is a convertible note that needs to be paid in cash.
Yes. And
so
we're recording this on February 25th. So it's Monday, February 25th while we're recording. The convertible is due Friday, March 1st. So
right. The convertible is due Friday, March 1st. The CEO on this same day, the 25th of February, is being pursued by the SEC again. We know that January Model 3 deliveries were horrible, down 74% December to January at 6,500. We know that there is capital tied up as ships, head to steam to China and to Europe, where demand in both places seemed tepid. So to me, at this critical juncture, March 1st, we've got the CEO in jeopardy again, and we've got capital tied up. I don't know how they're going to, what the sequence will be, but if they pay this convert, which if Elon has his brothers, I'm sure they will, but directors may be thinking differently. If they pay this convert, they still need to raise capital, thereafter. Mm-hmm. I mean, they will diminish their capital to a point where you can't run an automobile company on the cash they'll have left. So it really is a very interesting time intra-quarter. All that's going on in terms of, like I said, capital tied up on boats, CEO in trouble again, and the maturity coming due, in a couple days.
And on that cash topic, obviously they reported that they had $3.7 billion of cash on the books as of December 31st. But I know a lot of people have done analyses that, based on the interest income, that make it appear that the average cash balance intra-quarter was probably quite a bit lower than the $3.7 billion.
Yeah, the intra-quarter average cash balance was probably about $1.4 billion if I'm generous. So whatever window dressing they do at the end of the quarter, whether they draw down on the asset-based loan at the end of the quarter to window dress cash, whether they're doing some type of reverse factoring to window dress cash. If I'm a creditor, I can do that simple analysis on the interest income, and I can figure out that this company is in a much different cash situation than it is on, December 31st, 2018 at 11:59 with 59 seconds. That it could change on January 1st. So, yeah, I have the same read that the intra-quarter cash gets dangerously low.
If it had been around 1.4 billion and got drawn back down to near that level, and then they pay this 920 million, how can they? And they have all these cars on ships. They seem to be in a very dire situation. It's almost unfathomable to me. But
yeah, well, Elon and Deepak have said in the past that the minimum cash balance they should have to run this company is $1 billion. There's no math I can do where they pay this maturity and they're sitting with $1 billion or much over $1 billion once they do. And I think the other thing is, if you're a director, this is not about you can't run a car company week to week like this. And okay, we paid our convert, but now we don't have the money to run the company. That's reckless to do in and of itself. If that is the case, and there are reasonable cash flow forecasts that are being produced honestly within the company and being shared honestly with the directors have to ask themselves a real question about whether paying this maturity is what's in the best interest of the company, its employees, its creditors. This is not just run for share. They have other stakeholders here, and they need to consider them.
Mm-hmm. Of course, they also have the stakeholders of their customers who deserve to have a supercharging infrastructure that they were promised and parts available when they have issues where they maybe had a fender bender or something and need a new part. But we're not seeing that with some of those other things too. So, and of course, the ultimate safety issue, but I talked about that in episode 19. So go back and listen to that one if you're interested.
No, I did listen. It was excellent. Yeah, I think what you said is basically what we've done is we've exhausted the demand from early adopters, whether those are Silicon Valley people or, kind of gadget guys and tech guys and people who have money to throw away on a third car because they're in a financial position to do so. And that's great. But if you're going to get to the mass market, which has always been the thesis here, you need to produce a car that is suitable for a practical Midwestern person who drives in temperatures below freezing, who uses that car to get to work to make their living. And that is different than selling, in Silicon Valley to a guy who works at Oracle and has 4 cars in the driveway. And that's where the problem is going to be with all the things you mentioned, as far as service levels, service parts availability, and the supercharger network. It just hasn't kept pace, and people won't tolerate it in the mass market.
Mm-hmm. Definitely not. And the fact that when he announced the Model 3, the $35,000 price was plastered on the screen so prominently, and that car is still not available. I think the cheapest one right now is around $42,000 with only half of the tax credit, of course.
That's right. And I think they just recently pulled the $35,000. They forever they had the $35,000 version of the Model 3, but it always said available 4 to 6 months. And I think it was over this weekend.
Short range version. Yeah, I think it was within the
one
last
everyone was
5 or 6 days that they may have taken that off the website. I don't remember the exact date. That's another,
but you got to ask yourself, why was it pulled? Did a regulator, did the Federal Trade Commission come in and say, hey, you can't market a car and say it's due in 4 to 6 months for the last year if you don't have a reasonable basis for it to be, ready in that time frame? Is this legal? Or did, for the brief period that Dane Butswinkas was there as general counsel, did he say, hey, you can't run it like this? I don't know the answer to that, but it is curious to me. Again, I use that word a lot with these guys, that got pulled. I don't know what the motivation was, but it's interesting.
And I don't remember the exact timing either of when that got pulled versus when Dane pulled himself or was pulled or however that went down exactly. Yeah. It is quite clear that the timing of Butswinkas leaving was likely tied to this tweet from last Tuesday night with the 500,000.
Yeah.
Then the
I'm not quite so sure
correction.
About that, to be honest.
But
I'm not quite so sure about that
be?
Because, that tweet was sent February 19th. I think he came out, the 8K came out related to Dane Butswinkas the next day, and they had a replacement named. Now, I guess you could argue, he saw it, he said, this is ridiculous, and they quickly tapped some young guy on the shoulder, and he took the job. But that would have happened in a very, very tight time frame. For me, I don't know. Butswinkas, I know people who know him, who have used him. They said he's a tremendous lawyer, and then you can read on the internet, and, it's all the same, but this is someone who used them. And, a guy like Butswinkas, he relishes the fight. You know what I mean? This is his job. But the only time I find that attorneys like this leave a client or are fired by a client, whatever way it happened, is one of really 2 things in my experience. Either they don't think that the client is giving them the full set of facts, right? And lawyers hate that, to go and, potentially go to trial and get embarrassed because the client has not told them everything they need to know, or the lawyer has given counsel to that client, and the client has told them, has rejected that counsel. Neither of those things would shock me with Musk, but I don't know the terms of his resignation at all. Just speculating again.
Yeah, and back to Butswinkas, I believe Montana Skeptic spoke highly of him as well, I believe. And the firm that he's the chairman of, Williams & Connolly, I believe is who Brett Kavanaugh worked for, so he's our newest Supreme Court justice. And I think maybe one other Supreme Court justice used to work at that firm. So it's a very legitimate firm. They get referred to on the television show Suits, which I occasionally hear in the background. So they're a very legitimate firm, and he's the chairman.
Oh, they're beyond legitimate. They're about as white shoe and as respected as they get. And I know from people, like I said, who know him, said, Butswinkas within, he's often litigating against the SEC and against the DOJ. But he is tremendously respected within those two institutions. So, in fact, when I saw him get hired, I said, wow, this is probably a very smart hire. I was always skeptical about what due diligence he did going into the job, and I thought it was a weird transition because general counsel usually aren't from the litigation side. That said, given all the litigation that's forthcoming for Tesla, maybe having someone like him quarterback it all made some sense. But obviously, similar to Dave Morton lasting 27 days as chief accounting officer, he left in a very brief period of time. I don't know I don't know if it's something he saw or his interactions with Musk, or I have no idea. But to watch very, very pedigreed people change their job and then leave so quickly. I mean, he's been at like Williams & Connolly for 30 years, and he just lasted 60 days at best. I mean, there's something. It's got to tell you something. Something is. It's got to be absolute turmoil within that company right now, particularly tonight with this show cause order and SEC trying to get him in contempt of court. I can't imagine what's going on internally with a 34-year-old CFO and a 40-year-old general counsel and CEO whose future is uncertain. And a maturity on March 1st.
It's going to be a very, very interesting rest of the week. Certainly.
Yeah, no doubt about it.
We kind of got going on the latest stuff. Let's back up a little bit. How long have you been following Tesla in general, and what brought you into following Tesla?
Well, I mentioned earlier, and this is like 10 years ago, I ran a small energy hedge fund, and we did a lot of alternative energy stuff, often shorting it. So I first saw this company at a conference when it was a private company. And I just sat in on the meeting because it was intriguing to me, this electric vehicle concept. And then I've always followed it from a distance, but I didn't really get engaged from a research perspective or re-engaged, let's say, until I'd say the beginning of 18 is when I really started taking note of the valuation, how small I thought the market was ultimately for the cars, the emerging competition. And then, the overlay to me has always been this, and I've said this to people before. If you do auto manufacturing absolutely perfectly over the course of an economic cycle, you'll be lucky to earn your cost of capital. You'll be lucky to be afforded a 6 to 10 PE multiple, and you'll be lucky to avoid bankruptcy. So knowing that's the background of the industry they're in, and those are the really good guys, that's what they get. That's what the market affords people who are companies that are really good at auto manufacturing.
Like Toyota, Honda, Ford.
Yeah, exactly. GM and Ford traded 6 times earnings or 5.5 times earnings, and they're pretty damn good at what they do.
And that's when it pay dividends.
Yeah, right. But that's when it kind of got on my radar screen, where it just didn't make sense. And then as I got more engaged, and I started seeing, the outlandish claims, the missing of targets, and now what's come clear is a quality issue. And then I'd say the other thing is that the narrative that was always sold to the street was that we have unlimited demand. And I always thought that was outlandish. There's nothing that has unlimited demand, except that people are giving away money. And our only constraint is supply and our ability to produce. And so I hate hearing outlandish statements like that. I got a lot of people telling me never bet against Elon. That's like a dog whistle for me. Like, I hear
there's a Twitter account with that name, I believe.
That's
Don't
right.
bet against Elon.
Whenever you're deifying anybody, I said I just got to keep an eye on this one. Now it has not been an easy short. There's no two ways about it. But it had all the markers for me to be involved, and so I am short the stock via elongated puts, and I have been for quite some time. As we do work on our own and as a group, I get more and more confident that the thesis is correct. But it will not. This short will not work because one day somebody decides to value it like Toyota. This stock will work because of creditors and because of a lack of cash flow and maybe the inability to raise capital. But if you're sitting around hoping that the people who own the stock, who basically are cultists, are going to just wake up one day and decide it's overvalued, it's a bad thesis, and it's not why I'm short, and I'm sure it's not why anybody's short who's relatively intelligent.
Back to the infinite demand thing that they tried to portray. I think I've been following it at least at a distance for probably over a year now, But I remember distinctly when the 5,000 car per week production target was allegedly finally met on June 30th.
Right.
When I watched the share price following that event just on July 2nd, 3rd, and 5th, the share price just collapsed. In my head, it solidified that it's not about the production. And for a long, long time, I've had the view that the market size is limited because personally, I'm not super wealthy yet, so I would be hard pressed to justify paying over $40,000 for a sedan. So, knowing myself and people that I see in my everyday life, knowing that we're not part of the market that can afford a Tesla, even a Model 3, I have a lot different perspective than most people in Silicon Valley or even like the wealthy parts of New York or lots of other parts of the country. So I feel like I've had an advantage in viewing Tesla because of my perspective in that regard. But I definitely agree that the unlimited demand thing doesn't make sense.
No, and when you get to the market for first of all, sedans are out of favor in general, right? Everyone's buying SUVs, and so you look at the traditional auto manufacturers; they're de-emphasizing sedans. I think Ford's getting rid of them altogether, other than like the Mustang and some really kind of iconic cars. So, and then you think about sedans are not even in favor, and then when you get to sedans over $40,000, it's a very small market, and then haircut that market again by how many people want electric cars. I mean, it was just silly, but you often find that like on Wall Street, you got people from a certain socioeconomic background in general. Same thing on Silicon Valley side of the country. They take this stuff because they see it in their neighbor's driveway. They think this is the rest of the world. Well, yeah, if you go to San Mateo, California, you'll see a Model 3 or a Model S every other car. But that's not true everywhere else. And you're right. It's good that you have that perspective because people just took that narrative and never even thought through it. They just sat there and said, when can Elon get to 5,000 cars a week? Which, by the way, he never has consistently. And by the way, and just to circle all the way back to the beginning, if you think about what he's in trouble with again for the SEC, is again his prognostications or his predictions about production. They're already under investigation about the predictions he made back in the fall or summer of 2017 about getting to 5,000 a week by the end of 2017 and 10,000 a week by the end of 2018. So he's already got everybody in his place or subpoenaing him and suppliers or whatever on this very issue. And then he has the audacity to go on Twitter and make another prediction around this very same issue that is, again, materially false. I mean, it's incredible.
Mm-hmm. And we'll see how quick things happen this week, I guess, with how that goes down.
Yeah, I don't know. I don't know the process with the legal stuff.
Speaking of this week, something that hasn't really, I don't think many people are aware of it at all, but the Twitter user Plainsight, which I believe is run by Aaron Greenspan, who was a contemporary of Mark Zuckerberg at Harvard, I think, back around the time of the creation of Facebook. He took the initiative to pay some money to actually get some of these filings for some of the ongoing suits with Tesla. And apparently there are a series of depositions that are going to be taken beginning Wednesday with Kimball Musk, which is Elon's brother, of course, who is often seen wearing a cowboy hat. Has a specialty.
I don't know if you're allowed to wear that hat I don't know if you're allowed to wear a cowboy hat during the deposition. I don't know.
I don't know. They might let him. I know his expertise is the food industry. I'm not sure what he brings to the Tesla or SpaceX boards particularly. But on Wednesday morning, he gets to provide a deposition. So go Kimball.
Yeah. I mean, I looked at that list, and it's kind of like a month and a half or 2 months of successive depositions, with the last one being Musk, and that's obviously related to the Solar City bailout when Tesla in November of 2016 Solar City was going to fail. Solar City should have gone bankrupt. But again, Musk and his cousins had margin loans against the stock. They needed to save the stock, and they bought it out at the expense of Tesla shareholders. So that's that lawsuit. And when the postmortem is written on this whole Tesla story, that will be the seminal moment. The moment they went in and bailed that company out and took on $2.6 billion of debt and bought a company with no synergies with the auto business, everyone will look back in amazement in retrospect. But
they might have been able to successfully roll out the Model 3 if they didn't have the Solar City albatross hanging on. I mean, just look at Buffalo over the last few weeks.
Yeah, I mean, they should have stayed a high-end car manufacturer, making the Model S and making things like it and selling it to wealthy people for, compete with Ferrari or compete with Porsche or whoever it may be. And be an artisanal car maker, for wealthy middle-aged men in a midlife crisis, whatever. There's a good market there. But going into the mass market, which I described earlier and how difficult it is, that was the fatal mistake. The other fatal mistake was being completely vertically integrated, not having dealerships and a service network, and not having a place to outlay put these cars to when they're produced, and that's why they're strewn hither and yon across the country in dusty lots. Being vertically integrated was a either ignorant or arrogant decision, and it might have been a combination of both.
But that's the mission, to push the advent of electric vehicles. That's the whole.
There's going to be
mission.
plenty of other people who are going to do that for him. He said on CBS on 60 Minutes, which it really caught my ear, having been around the markets for so long. And he basically said, if Tesla goes bankrupt, but in doing so drags the rest of automobile manufacturers into electrification, that will be positive. And that is not a position you can take if you're the CEO of a public company. If you take the public's money and you benefit from all these tax incentives, apart from that, you can't just do a victory lap if your company fails. And I tell you, if I worked at Fidelity, if I was the guy with gray hair at Fidelity, at T. Rowe, Bailey Gifford, and I would say, hey guys, how can we take our investors' money and invest with a CEO who not only has to settle a fraud case, but has gone on national TV and said, if we fail, okay, we gave it a shot and we move the earth towards sustainability. That is not who you can invest with. If you are Fidelity or T. Rowe or Bailey Gifford, or I guess if you're Gerber Kawasaki, you can. I guess if you're ARC, you can. But I can't believe that anyone could go into an investment committee, make this pitch, and not have a guy, or a gal who runs the investment committee and say, hold on a second. I just read these 10 things in the paper. We're still going to put money here? It shocks me.
And of course, ARC reduced their holdings by 44.5% in quarter 4 of 2018. So
right,
and they have the infamous
by the way,
$4,000 price target.
Right, but she goes on CNBC and touts the stock, and nobody on CNBC does enough background work to see that, check the filings and ask her, okay, I understand you still like the stock, but you did cut your position by 44%. Now, her answer, I think I've seen given elsewhere, is that our max.
I think that's what it is, right?
I think her own internal risk management rules say that once a position gets to 10%, they need to sell it. Now, she cut it in half essentially. But my only point is, if she's going to go on there and tout this stock, then you know what, Melissa Lee, whoever's hosting the program at that time, got to ask her, why have you cut your position? Nobody even asked the question. She might have a legitimate answer. Ask it. Do some work. The journalists, and that's not, I shouldn't say it. The journalists have started to come around, and some of the journalists, Laura Kolodny and Charlie Grant and Lynette Lopez, I'm sorry, Neil Burdett. There's been a handful of them that have done very solid work throughout, but the rest of
they're still working too. So they're doing excellent work. No, but the rest of the journalists have been aiding and abetting this thing the whole way through, and I know we're in an era of access journalism where if you say something about Tesla, you don't get access to Tesla anymore. Phil LeBeau,
man, I mean,
Tom Randall.
Don't even get me going.
Sorry, I'm
don't even get me
naming names.
Yeah.
I'll quit.
But anyway, okay. So, I know we're kind of riffing and we're all over the place. The other thing I'd say is, if you're a consumer products company, well, put it this way: Tesla doesn't have a particularly good manufacturing operation. Tesla does not have a good service operation. Tesla does not have a good logistics and delivery operation. Tesla has one thing that has been incredibly valuable for a very long time, and it's its brand. I mean, you talk to people who have Teslas or aspire to Teslas. Tesla is this brand that they really can't wait to get their hands on, or if they have it, they love it, regardless of its problems. But the problem now is the most valuable thing they have, this brand, is getting degraded daily. And that's fine when you want to sell the cars to these early adopters and stuff. But like we said earlier, if you're trying to get to the mass market, you can't have Consumer Reports pulling their recommendation. You can't have anyone can go on the internet and find out all of these service issues and quality issues. You can't have people being burnt to death in 15 seconds and fires that fire departments can't put out. That stuff is the mass market stuff that you can't recover from.
Doors that the emergency personnel can't open, which the fact
the NHTSA has to do something.
Yeah, and ironically enough, I'm going to go on a slight rant here. I don't remember where it was, but somewhere in some forum, I believe Elon Musk was bragging about the fact that it might have been a written article, but is basically pointing out that Elon Musk directly had his hands on the door handle design. It might have been the Charles Duhigg piece in Wired, actually, but I might be misremembering. But thinking about that in light of yesterday's wreck, just I don't have words, so I'll just stop.
Yeah. I mean, I'm not an engineer by any means, but I did read that article. I think it's the one you're citing, but I definitely read it somewhere that this was like almost like a mini obsession for him. I think he's more into like the aesthetics of things than how they actually work. And I think he has a thought in his mind, and everybody scrambles to get it done in haste. And I think you're dealing with that. And you listen, we can go in a more significant way about, how the testing wasn't done on this car, how these are effectively people beta testing cars to this day, how we can go to, we are now building less than 5,000 a week with the aid of a tent that was never foreseen. And there are permit issues with that tent, and there are safety issues with that tent. And there's more fires at this auto plant than I think has ever been recorded in terms of how frequent they are. I mean, it just sounds like an organization, both operationally and leadership-wise and financially and legally out of control.
Mm-hmm. Indeed. There's just so many aspects of it. With your expertise, I think we want to stick to the financials of it. Are there any particular items that you think we haven't covered quite yet?
Yeah, it came up on Twitter today, but I've been looking at it for a while. Not looking at it, but cognizant of it for a while. People are focused on this convert. But, someone mentioned all the purchase obligations the company has, largely to Panasonic. And, if I've set these purchase agreements with Panasonic, and they were based on the predictions for production that we know have not come true, I look at them as the most significant creditor in this situation. They have equipment in that factory. So it just, I think to the average investor, they probably don't get into page 120 and look at the purchase obligations of customers. But to the educated investor, long or short, it's a significant thing to be mindful of. And so anyway, but from a financial perspective, there's 1,000 things.
Yeah, on that purchase obligation note, that was one of the things that I had in mind earlier and didn't think of. But in the 2017 10K, I think it was something like $2.8 billion of purchase obligations for the year 2019. And in the 2018 10K, it jumped to like $4.3 billion. So it increased by something like $1.5 billion for the year 2019 from the 2017 to 2018 10K. And I don't know how much of that is Panasonic versus other suppliers, but it seems like a possibility. This is another one of those curiosities, but it seems like a possibility that maybe they got some rebates for quarter 3 and quarter 4 and got those by agreeing to purchase more in the future, which with the demand situation, that might get kind of hairy if that is in fact what happened.
Yeah.
Was that kind of the take that you had?
Yeah, that was where my head was at. And the other thing I'd mention is that the third quarter, obviously for Tesla, was like a miraculously profitable quarter, and probably will never revisit profitability like that again. But if you looked at Panasonic's report from the same period, they lost money in the business that sells into Tesla. So it begs the question, like, why is your key supplier losing money in a quarter where you're making your most money? And it may be what you're describing is that they gave them rebates or breaks that caused Tesla to be more profitable, them to be less profitable, and then they said, okay, we're going to hook you up this quarter, maybe the fourth quarter, and then they kind of pushed back those purchase obligations into the following year, and just kicking the can down the road. And listen, Panasonic's in a tough spot, and if you've ever followed Japanese companies, they're very different culturally. They're very, very slow to admit mistakes. It's a matter of honor and everything else. I mean, I've always said we won't know Panasonic's really in trouble with Tesla until some executive in Tokyo launches himself off the side of a building. I mean, that's kind of how tough the Japanese culture is in terms of admitting a mistake. So anyway, but I think you're right on to it. I think if Panasonic and others gave them a break, and I don't know what Tesla tells these guys. They might say, listen, if you don't give us a break, we're going bankrupt. So then you definitely don't get paid. So why don't you play ball with us? I don't know what the gamesmanship that goes on, but I wouldn't be surprised if that's something along the lines of how it goes. But that can only go on so long, That can only go on so long.
And thinking back to quarter 3 and quarter 4, obviously in Tesla Q we covered this a lot, but I don't know that people on the long side paid much attention to the fact that quarter 4 had higher sales and deliveries than quarter 3 and less profit. Like, that looks to me to be a pretty clear red flag, but some people have totally brushed it aside.
I think it was, correct me if I'm wrong, I think it was 7,000 more sales Q4 versus Q3. Or was it 7,000 more Model 3s? I forget which. But
I don't have those numbers in my head.
But I think it was 7,000 more. I think they went from like 83,000 total to like 91,000, something like that. And, you're right on to it. I mean, that's called a decremental margin. I mean, you're making less money on each incremental sale, and part of that's explained by the average selling price going down because they're selling more Model 3s and because they cut prices, and some of that's explained by less regulatory tax credits, whether they be GHGs or zero emission vehicles credits, and that's the one-time type of stuff. I might have used the word gimmicky earlier, but that's stuff. I mean, what you're trying to do when you're valuing a company is look at the sustainable profitability of the company, and those are not sustainable profits. And the inherent profitability of the auto business is miserable, and that is really the short thesis to me.
Just a matter of how long it'll take for the market to totally figure it out, I guess.
Or a creditor. Or a creditor.
Yeah. On that topic.
Or a director.
What is Moody's doing? Like Moody's said that they had to get to 5,000 per week, and I guess they said they got to 5,000 per week. So.
Well, no. Moody's said a couple things. Moody's said they had to get to 5,000 a week, and this is now we're going back to what are we talking about? March of 18, maybe, when they downgraded them. They said, they said they need to get to 5,000 a week sustainably. No, it's not these one-time targets where we do it for a week and everybody applauds and then we move on. 5,000 sustainably, which has not been the case, and they said they needed to raise capital, which they haven't. So, but listen, I've been bitching and moaning about the SEC forever. I'm kind of happy with them tonight, but by and large, I haven't been happy with them. The only people worse than the SEC are the other credit rating agents. I mean,
are they even slower than the SEC?
Well, they're slower. They're very conflicted because there's only really, if you want to throw in Fitch, there's only 3 of them: S&P, Moody's, and Fitch. They're paid by the issuer, and you can go back in history to the housing crisis and everything else. I mean, they do not have a good record of either being proactive or accurate. They're like the SEC. Like once the bodies are strewn about the bar room after the gunfight, that's when they show up to find out who to arrest. And so yeah, they don't have a good track record. But they said in print what it would take for them to maintain their rating, which was $5,000 a week sustained and raising equity capital. $5,000 a week has not been sustained, and equity capital has not been raised. But they'll wait until there's a default, and then they'll come in.
Mm-hmm. And on the topic of 5,000 per week sustained, not happening yet. Just go look at the quarter three. I'm talking to the listeners here. You know this, Ed. Just go back and take the number of cars produced in quarter three and quarter four from Tesla's releases and divide that by 13, and it isn't 5,000. It's less than 5,000. It's very simple math. So do the math yourself.
Yep. It's always a burst week or an extrapolation.
Mm-hmm. Yep. Like the 500,000 per year rate that Elon meant with his tweet last Tuesday. Yeah, I believe you, Elon. So Moody's needed 5,000 per week and a capital raise, and neither have happened. And here we sit.
Right. Correct. Yep. So when will Moody's act? Moody's will act after there's a default, and they'll come in and downgrade the thing to not rated. Their history is horrible. Mm-hmm. I don't really know how they work internally.
I wonder if Tesla has any hope of being able to raise now, even with this latest news from the SEC tonight. Right?
Yeah. I mean, prior to this, I was unsure if they could raise because,
they did check the WIXI box, the well-known securities issuer box, whether that was correct or not. Well-known seasoned issuer. Yeah.
Whether that was, we know that every time there's been a mistake by Tesla, it's been classified as a clerical error. There's also another school of thought, that they've taken an interpretation that they're still a well-known seasoned issuer, that maybe in fact they've never been told outright that they are not. But, and I don't want to bog everybody down with it, but they did file a Reg D waiver concurrent with the settlement, and the Reg D waiver allows you to do a private offering. And, one implication of that may be that you would only apply for that. It's not the only reason you would, but that they applied for it concurrent with the settlement with the SEC is that they weren't a well-known seasoned issuer. But the SEC said, okay, well, you can do a Reg D offering because that's what sophisticated accredited investors. I don't know. I have filed a Freedom of Information Act request to try to get that answer. I've called multiple times. They don't answer me. But so anyway, coming into tonight's events, it was unclear to me whether they could raise. Because my thought has always been that Musk has always been a readily issuer of equity. He has had no problem issuing equity over the course of this company's history. And when he's done it, the stock has worked well. Why would you introduce this company to existential risk when you simply could go raise money and take that off the table, at least intermediate term? All of this austerity now and all this Spartan living for a growth company makes no sense to me. So I've wondered up until now whether he could raise equity capital. Now, tonight, now that he is, we've got the SEC. The SEC is the one who has to make the registration statement effective if he was going to go issue capital. And now they've got him where they're going to go after him, for contempt of the agreement or contempt of court. I don't know how you could get an effective registration statement while this is still an outstanding issue.
Yeah, I don't either. I wonder if the Reg D waivers will stay in effect even.
Yeah, I don't know. The only thing I'd notice about tonight's thing is that the consent, the show cause order is addressing Elon Musk personally. It does not address the company, right? And you could make the argument, since the company did not oversee his tweets, and because the company was party to the settlement agreement, that the SEC could take an even more aggressive approach and say, we're going after Musk again because he violated the agreement, and we're going after the company because they didn't abide by the agreement. Maybe they've chosen to split the baby and say, you know what, Musk out, you can raise capital because you're not subject to this show cause order. I don't know. I'm reading tea leaves here completely, and like I said in the beginning, I am not a lawyer, but that crossed my mind as I saw that. So
yeah, and of course, if Elon was gone, a lot of the long thesis would go with that. It seems to me that a lot of the Tesla bulls, a big part of their thesis is Elon Musk because he's this visionary genius, which is the view that he's tried to cultivate. Obviously, part
of the brand. He's a gigantic part of the brand. So I think this is why the SEC took the soft approach to begin with. They didn't know a way to separate him from the company without Now, I take a different view. I don't think that's their mandate to. And when you read the statement from Powell, Powell, when it happened, he says as much. He says, that sometimes there's some people that are inextricable from the company and its value, even if they kind of are bad actors in individual cases. He said, I'm paraphrasing. He didn't say it that way, but that's essentially what he said. So I think they've been trying to thread this needle of like, how do we sanction him but not kill, the stock? But now I think he might have pushed them too far.
Mm-hmm. All right. Well, we've covered quite a bit tonight. Any last items you'd like to cover before we wrap this thing up?
No. I think we covered a heck of a lot. Again, I think if I sum it up, the thing that gets these guys is that they are on a daily basis degrading the most valuable thing they have, which is their brand. And in a consumer products business, that's the death knell. And I think Consumer Reports was the first indication of that in the broader press and to a broader audience. And I think that's something, if they're going to continue to do that, they don't have the capital to bring it up to snuff, it makes the mass market impossible for them. Mm-hmm. My mom and dad will not put up with this type of service. I'll put it that way. Indeed they won't. All right.
Oh, I forgot to ask about Hot Pockets. Yeah. You had a Hot Pocket lately?
I can't lie. I'd never had one, and don't tell Elmer Fudd.
All right, I won't tell him.
But a couple of weeks ago, I think I was in a very bad state about the way the stock was acting. Like a typical day with Tesla, where something you think should cause the stock to go down 10% and it rallies up 2%. So I went down to Duane Reade around the corner in honor of Elmer, and I did eat some Hot Pockets, and they were delicious. And it's some high technology, the tinfoil thing and everything else.
Yeah. In the microwave, yeah.
Yeah,
I was
pretty impressed.
And you don't start a runaway fire. It's awesome.
Yeah, exactly. Anyway.
All right, well, thanks for joining tonight, Ed. It's good talking to you.
It was great.
And we'll have a fun week this week, I guess.
You never know minute to minute or hour to hour, day to day what's going on, but it's definitely feels like it's coming to a head. We'll see. I felt that before, but this week does feel interesting.
Indeed. And with that, we'll call it episode 20 of the Tesla Q podcast.
Thanks very much for having me. Bye.